Our portfolio doesn't have any direct exposure to property, and the reason is, despite the underperformance we've seen of late, the asset class is still expensive. It's still actually offering us negative returns over the next 3 years. Property assets have been heavily influenced by what's been happening in interest rates and bond markets, and so whether it's domestic REITs or offshore REITs, neither of those are attractive to us, and therefore we hold neither of them in the portfolio. So when we think about the return from an asset over a holding period, we decompose it into 3 things. The first is the yield that we get from the asset, and so on REITs you can look at the running yield. The second is the growth in distributions or dividends that we'll get over our holding period. And the third, and often the most influential, is the change in valuation. So in the case of REITs, it's the change in cap rate between where it is today and where we think a sustainable level of cap rate is. Cap rates are heavily influenced by bond yields, and given we have a view that bond yields are still likely to go higher from here, that leads into a view that cap rates will go higher in real estate values, and that repricing of cap rates results in a capital loss for investors on a 3-year horizon. Remembering that our horizon is 3 years rather than 10 or 15 or 20 years when we're making these decisions. We think so. Now we've been early on property and sort of wrong. It's sort of continued to rally as bond yields continue to come in. But as valuation-driven investors, we really just look at what is in front of us today. It doesn't look great if you believe that the cyclical growth story is improving and that bond yields are likely to continue to rise.